Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hello, welcome to BankTalk. I'm Jordan Kelly, your host and consultant at Remedy Consulting. Today, we are sitting down with Matt Pateri, CEO of Happy Money, to discuss consumer debt across the U.S. and its impact on community financial institutions. Happy Money recently released and concluded their credit check-in study, which focused on consumer debt and financial stress. And it yielded some really interesting takeaways for financial institution leaders looking to better support their consumer base. So without further ado, let's dive into our discussion with Matt. Matt, thank you so much for joining me on the podcast today.
Jordan, thanks for having me. It's good to be here with you.
So Matt, you and I, we talked a little bit before we jumped into recording today, but you've got this really interesting business concept. You've also recently run a 2,000-person study, which is what we really wanted to kind of talk to you about today. So give me a little bit of your background. Tell me a little bit about Happy Money. And then if you don't mind, give me some of the parameters of this study that we wanted to talk to.
Sure. Yeah. So I've spent the last 30 years of my career in consumer finance in just about every consumer credit asset class. So I've seen lots of asset classes. I've also seen multiple credit cycles and really bring that perspective to what we do at Happy Money. And Happy Money is a consumer finance platform. We partner with credit unions and banks and other institutional capital to originate loans for consumers to help them consolidate their debt and to save them time and money. I'm sure we'll talk a lot more about exactly how we do that. We, to date, have funded over $6.5 billion in loans, and we've helped over 350,000 Americans save time and money, as I said. So it's been a fun ride, and we've got a lot more ahead of us.
Absolutely. And it also sits you in a really interesting place to have this conversation we're having today, which is around consumer debt and how it affects particularly community-sized financial institutions. So
Yeah.
tell me a little bit about this. Give me a little bit of the background. Tell me a little bit about this study that you guys recently completed.
Yeah, so we went out and we surveyed American consumers, and what we found is that debt, and specifically credit card debt, is causing significant challenges for consumers. And to frame it up, there's over $18 trillion in credit card debt. I'm sorry, $18 trillion in total debt. Over $1 trillion of that is credit card debt. And it tends to be really high interest. You know, the typical rate is 23%. And so it's a significant financial burden. But what's really interesting in the study is it's also a big emotional burden for consumers. 40% of consumers, 40% of the respondents to our survey told us that they were extremely concerned about their monthly credit card payments, and it's affecting their mental health. Almost a third, actually over a third of consumers are telling us in our survey that it's affecting their ability to sleep. So it's really having a significant impact on the emotional health, not just the financial well-being of American consumers. And so that's why we think we're tackling such an important issue at Happy Money.
Absolutely. And something that I found interesting about the study, in addition to the fact that, 18 trillion in consumer debt. So talk to me a little bit. Help me break this down. So for example, you've got somewhere around 18 trillion in consumer debt across the US. If you assume 340 million US citizens, that's roughly 50,000 in consumer debt per person. Is that a realistic stat? Is that something that you saw?
Yes, but what I would focus on is, those are the averages, and what the study really helps to do is break down underneath the averages what we're seeing. And so if you look at credit card debt for, millennials or Gen X, roughly 45% of those households are revolving credit card debt. And again, typical interest rate's 22, 23%. So it's a really significant burden. And if you look at our consumers, the typical consumer, for the typical Happy Money member has credit card debt of around $20,000. So it's a significant burden for consumers that we're trying to help solve, along with banks and credit unions.
So you said the typical Happy Money consumer. Did your study prove out, or did you see anything just strictly in the stats that could lead you to believe an average, maybe an average consumer, how much credit card debt might they be carrying at any one?
While Happy Money, the typical consumer carries about $20,000 in credit card debt. The study didn't specifically focus on the average for all Americans, but what I think you do see is a significant burden for nearly half of American families. And so we focus a little bit less on sort of the average amount and more on the significant burden across almost most of the American households.
So let's dive into that from the lender's perspective. So you've got an increase, or really truly a high amount of debt laying with the consumers, and a certain amount of it, really a large amount of it, is within this credit card debt, which is, as we all know, very high interest rate. So if I'm a institution CEO and I am worried about the state of my consumers, or tell me this, are delinquency rates on the rise? Where are lenders feeling the most pressure?
Yeah, so I think one, this creates a tremendous opportunity in that lenders can step in, financial institutions can step in and help relieve some of the financial and some of the emotional burden for consumers and create long-term customers and long-term members. So there's a real opportunity for those institutions. Now, to your point, it's the old adage, it's easy to lend money, it's hard to get paid back. And so while doing that, we want to be really thoughtful that we're making high quality loans with good risk adjusted returns. And that's, I mentioned I've spent 30 years of my career in consumer finance. So it's absolutely our focus. If I step back and look at the consumer more broadly across multiple asset classes, there are places where we're certainly starting to see some stress. If you look at student loans, for example, now that the payment moratorium has been removed, about a third of student loans are delinquent. Those consumers obviously have a fair amount of stress. If you look at auto, especially subprime auto, down market, we're starting to see some stress there as well. And so, it's certainly something we're mindful as we move our way up in some of the asset classes and in the credit spectrum. Mortgage is generally performing pretty well. Home equity is generally performing pretty well. Cards have done okay. And in personal loans, for our portfolio, we've continued to see strong performance. But it's certainly something that we watch because we know, credit cycles do happen. And so we want to make sure that we're being really thoughtful and we're underwriting loans that'll perform well through the cycle.
We'll be right back.
Is your technology spend getting a little out of hand? Are you worried about making those big strategic moves because of those hefty vendor contracts? Or maybe you just feel like your technology is currently holding you back. In today's banking world, overspending on technology is a risk you just can't take. Going up against those major vendors on your own can be tough, expensive, and especially when the contracts are designed to benefit them. That's where Remedy can come in. Remedy Consulting helps our clients stay competitive and grow their business with the right technology, products, and their spending strategies. Not a Remedy client yet? Head on over to remedyconsult.net for a free review of your tech stack, spending, and contract terms. Even if you're not the perfect fit, you'll walk away with expert advice and confidence in your technology decisions. Check us out at remedyconsult.net or give us a call at 262-955-7776. Thanks for tuning in, and now let's get back to the episode.
So we'll dive into a little bit because I do want to ask you about how Happy Money is facilitating, this conversation with lenders. But let me ask you specifically, because my assumption here is that where Happy Money is focused on providing debt consolidation through personal loans, my assumption would be that the type of consumer debt that's best consolidated through a personal loan, what you would be targeting truly is that credit card debt. Do I have that right? Am I thinking about that the right way?
That's absolutely right. That's absolutely right.
Okay. So then if that's the situation, so tell me, do you have a little bit of a breakdown for me on are we seeing an increase in delinquency or just a difficulty in paying back or even just keeping up with payments on credit card debt as it stands today?
So I think it's a little bit of a tale of two cities to some degree. If you look at credit performance for cards, it's generally pretty good. If you ask consumers, as we did in our survey, how they're feeling, they're telling us that they're stressed, that they're feeling emotional stress, that they're certainly feeling the financial burden of, cumulatively $1 trillion in credit card debt at interest rates in the low 20s. So they're telling us they're feeling this emotional and financial stress, but the performance, the recent performance has been pretty strong overall. And so certainly something that we watch, but right now the credit quality from a financial perspective has been pretty good.
Would you say that you're seeing performance be relatively good? Would the reason for that be that consumers they've got a whole ton of credit card debt, but really, if I'm I'm looking at my Amazon credit card, every month I pay the minimum on it, so I'm always making my minimum payment. But really, my total amount of credit card debt is not going down. If that's the case, would that lend to the why it's performing well, but why there also might be high stress from the consumer standpoint?
Yes. I mean, one of the things we found in the survey is consumers want to pay down their credit card debt, but many of them, almost 1 in 5 of them, have not yet taken actions to be able to do that. And to your point, they're just making minimum payments. And if you just make minimum payments or, slightly more than that on a credit card with a 23% interest, it's going to take a long time to pay off that credit card. It's one of the benefits of a personal loan because it sets the consumer up so that if they make fixed monthly payments over a period of time, they'll get completely out of debt. The interest rates are lower, and so there's obviously an interest savings. Our typical customer saves about $7,000 over the life of their loan. So there's a real savings, but it also helps set them up, puts them on a plan so that they're not just making minimum payments, they're making consistent payments at a lower interest rate to actually get out of debt and take the actions to do so.
That's interesting. And it's a well thought out approach. So now let's pivot a little bit. Let's pivot to the mindset of I am a financial institution leader. Talk to me a little bit about how Happy Money really steps in and facilitates. Where would you say is your sweet spot in facilitating these personal loans?
Yeah, so one of the things that's hard is as we talk to our lending partners, one of the things that's hard for them is to compete at scale. Having a branch on the corner is not as valuable today as it was 30 years ago. Consumers don't walk into a branch and ask for credit card, a mortgage, or a personal loan. They tend to go online or they respond to direct mail. And to be sophisticated and to be able to originate and market online takes a certain amount of scale and sophistication. And it's hard for smaller institutions to make those investments. And so when they do go online, they don't tend to have the same level of sophistication. It becomes much harder for them to make it work. And that's exactly what we do. So we do all of the marketing to originate the loan. We do all of the underwriting. We do all the fraud checks and the processing of the loan. And what we give to the financial institution is a fully underwritten, high quality loan that's priced appropriately, where they'll get a good risk adjusted return. They fund that loan and we service it. And so it's a very light lift for them. It doesn't use significant resources. They don't have marketing dollars at risk, but they get a high quality asset and they get a new customer. And as I said before, we've brought 350,000 members to credit unions across the country. And so, now these members are getting other products as well. And that's really the benefit to our partners.
So in your model, talk to me. You spoke to it, but give me a little bit more detail on the origination process of these loans.
Yeah, so the key here is consumers want a really simple, frictionless experience. And so the key is to make it feel that way, but to have all of the sophistication underneath. What we don't want to do is the mistake from the financial crisis 20 years ago, where the way that financial institutions made the process easy was they just made it, had lax standards. That's obviously not what we want to do. And so our proprietary platform, which we call Hive, makes it very simple. It's a fully digital process. The consumer can go through the process in a matter of minutes and get fully approved and fully underwritten. And so we make it really simple. Underneath that simple consumer experience is a tremendous amount of sophistication where we're doing fraud checks and we're validating income and we're doing, sophisticated underwriting to make sure that this is a well underwritten loan. But to the consumer, it's a few simple clicks. And that's the important thing that we bring. And again, that's why it's hard for many for many credit unions and banks and community banks to be able to do this effectively, because it's a significant investment we made in Hive to make that process both sophisticated and seamless.
So something that you and I talked about a little bit earlier was around the fact that if you are a community bank, community credit union, you might be light on resources, or your resources they're being used to their full capacity. Whether that's dollars, people, time, whatever that might be. Now, fintech as a whole, financial technology across the board, really important to uh to an institution leader of any size. So, we know that these leaders that they've got a lot on their mind. The board's CEOs, they've got a lot that they are prioritizing. So what I'm hearing from you is that a really big portion of Happy Money, in facilitating these types of loans, is really just taking things off of the plate of the bank team. So if that's the case, tell me a little bit about the flip side of that. It's not as if there's no involvement or no investment from the side of the credit union or the bank. I guess, what would you say is an expected investment from their side, purely from a time and a work perspective? You hand them a loan that's ready to go. What do they have to do next, and in order to evaluate whether this is something that's a good fit for them?
Yeah, so we hand them a fully underwritten loan and they fund it, and we tell them, we put it in the funding files, we show them where to fund it. So operationally, it really is a very light lift. Now, certainly because these are depositories, they're regulated and they're very focused on risk. We go through a vendor review process and compliance reviews to make sure that they're comfortable with us as a partner. And the credit underwriting policy that we're using, we spend time with our depository partners to make sure that they're comfortable with the policy, that they understand the policy, and ultimately they adopt it as their policy because we are underwriting on their behalf. It is ultimately their credit policy. And so we spend a significant amount of time with our partners to make sure that they understand what we're doing, that they agree with it, and that they're comfortable with it. But operationally, the lift is very light, and there's not significant work. We do the marketing, we do the servicing, and we do all the underwriting in between. But certainly, it's a partnership, and so like any good partnership, there's lots of ongoing communication to make sure that we're helping to solve their challenges.
So overall, here's what I've heard kind of in our discussion so far, is that it's a time of economic uncertainty from the perspective of the consumer, meaning at the consumer level, they're feeling a lot of stress when it comes to their financial situations. Now, if I am a financial institution, how can I advance lending strategies even in this time of, consumer uncertainty?
That's right. And what many of our partners tell us is they're looking for assets. They're looking for high quality assets, and they want to expand their customer or their member base. And their options are somewhat limited. It's hard to grow a credit card portfolio in a big way. Many of them have gotten into indirect lending, and that's a really challenging business. Not only some of the credit quality issues that are starting to pop up there that I mentioned earlier, but the margins there are so thin, and it's hard for them to compete. They're really only competing on the basis of price. And so that's a really tough business with not very good returns. And so they're looking for assets that they can originate that are high quality, and personal loans fit that well. Now, the weighted average life is about 2 years. So it's similar to an auto. It has better returns than an auto. And as I mentioned, it's got the benefit of really helping these consumers. And so it helps make a new member or a new customer that then can be cross-sold other products for the bank. And so it's a good, many of our partners just find it a good fit to solve their financial challenges, to grow high quality assets, and to bring on new members and grow their institutions and help people in the process.
And I have to imagine that particularly if you are providing from a consumer standpoint, or a consumer viewpoint, if my credit union or bank is providing to me an easy to use solution that's going to solve something for me that has been very high stress, not only from for the credit union or the bank, not only is it, potentially bringing in a new customer, but because I, as the customer, an issue of mine has been solved in the past by something that they made very easy, have to imagine that that builds loyalty, meaning looking at a lifetime value of a customer has got to shoot from the roof, particularly if you start the relationship with something where, that trust was built quick and fast.
That's exactly right. And that's why we think that the survey that we did of American consumers is so valuable, because, it's somewhat easy to look at the numbers and say this is a great asset and there's a real need, and you can see the numbers there. But what's important is behind each one of those credit card balances is a real person, are real families, and they have real feelings. And we can't ever lose touch with that. And so the survey brings a little bit of that to life, that there is a real emotional need here. And for financial institutions that can solve that emotional need, you can make a customer for life. And that's really where the magic happens. That's where it's really special.
I'm going to throw you a little bit of a curveball here, meaning that I did not prep you for this question beforehand, but it just popped in my mind. It's a little bit it's an interesting perspective. Now, in your business model, this is something that you would be handling, and this wouldn't actually fall on the bank or credit union. In your, whether it was through the study or through your business up until this point, have you seen a challenge in getting consumers to understand the benefit of a personal loan to pay off credit card debt specifically? Because I think and I'm thinking about, maybe some of my personal connections, some of the friends and family that I have who, if they are in this category of having a very high level of credit card debt, sometimes I do feel as if the financial education overall is just not there to understand the benefits of a personal loan to offset that debt. So, have you seen anything in that space? Is that an area that you have to overcome, really kind of the educational aspect?
Yeah, there's certainly an aspect of that. Consumers who come in and go through the process and get a loan or get a quote for an interest rate, it's pretty obvious that there's significant savings. But the challenge is getting them to that point. And we mentioned in the survey, almost 1 in 5 consumers want to pay off their credit card debt but haven't taken any steps to do so. And some of that is certainly education, knowing what to do and where to go, and some of that is inertia. It's sometimes hard. It's hard for people to get over that initial step. That's why we try to make it really easy. It's literally a function of going online, and we make the process as a matter of minutes. But we do have a constant education process to help people understand how simple the process is to be able to take those steps toward a better financial life, and make sure they understand what they need to do to be able to do so.
Well, thank you, Matt. This has been a really interesting conversation. I know we covered quite a bit, but is there anything that you think we didn't hit today that you think would be important if, specifically if you're a credit union or a bank leader who's looking to build out their deposits, with a low lift of effort, anything else they need to know or that they should be thinking about?
Yeah, Jordan, well, first, thanks again for having me. We think it's really important. We think that this is a product that has a real positive impact on consumers. It can have a real positive impact for our partners. We also think it's important as a fintech to be really good partners and to be risk oriented and really focused on credit. And there is always a danger that as people are lending, they're not thinking about ensuring that they're underwriting good loans. And that's what we're focused on. And so, as we bring on partners and as we've grown with a number of our partners, we really think what we do special is create real long-term relationships, not just with consumers, but also with our financial institution partners, because we're so focused on credit. We're so focused on making sure that they get a good risk-adjusted return. And many of us have sat in their seat and sat inside regulated institutions, and so we understand what that's all about.
I appreciate it. Thank you, Matt. Thanks for joining me today, and honestly for bringing all of this the data with you from your study. I always think that that's really interesting to hear about. So I appreciate your time.
Thank you, Jordan. Thanks again for having me.
You have a good one. That's it for Bank Talk. Thank you for listening today. Have a good day and keep on learning.
Thank you for joining us on the BankTalk podcast, brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.